Hey everyone, and welcome. Today we're putting China's economic miracle right on the examination table. In this explainer, we're going to completely demystify the dramatic economic shifts happening in China right now. And we're basing this on a really fascinating analysis by Didi Sir. You see, beneath the surface of what was once the world's most unstoppable growth engine lies a highly complex mountain of debt. So let's conduct a full economic autopsy to uncover what this really means for the global economy and the massive strategic window it's opening up for India. To set the stage here, we absolutely have to start with this brilliant analogy from Didi Sir's report. He says, China's debt crisis is less like a heart attack and more like high cholesterol. Think about what that actually means for a second. High cholesterol might not kill the patient suddenly, overnight, right? But if structural reforms are delayed, it fundamentally drains the patient's strength and vitality for years, maybe even decades. We aren't looking at sudden death here. We are looking at a deeply sick patient.
So, to properly diagnose this patient, here is our roadmap. We'll cover 1. The misdiagnosis, 2. The true symptoms, 3. The prognosis, and 4. The impact on India.
Okay, let's dive right into this with Section 1, the misdiagnosis.
Now, you've probably seen those viral posts screaming that China has $60 trillion in hidden local debt and is on the verge of total collapse. Well, the data shows that's a massive misdiagnosis. The real number is actually 60 to 66 trillion yuan. And when you translate that, it's a roughly 8 to 9 trillion US dollars. Now, don't get me wrong, that is a staggeringly huge number, but this whole viral myth comes from a careless translation error confusing the currencies. China's total overall debt is closer to $50 trillion, but that scary hidden local debt everyone talks about, that's just an $8 to $9 trillion slice of the pie.
To really understand where it hurts, we got to break that total debt down. The central government's debt is actually surprisingly moderate. Households are seeing their debt rise, sure, but it's not the main crisis point. The real danger zones, those are the corporates, which are carrying extremely high debt loads, and the local governments, which are just completely drowning in it.
And that brings us to the hidden bomb in the whole system, LGFVs. That stands for Local Government Financing Vehicles. Basically, these are off-balance sheet entities set up by provinces to borrow massive amounts of money to build things like roads, airports, and industrial parks. But here is the fatal flaw. A lot of these huge infrastructure projects generate very little actual cash flow. So the revenue coming in is way lower than the interest payments going out. It's a classic compounding debt spiral.
Which leads us to Section 2, the true symptoms. For literally 2 decades, China's spectacular growth model was this simple, repetitive loop. Sell land, borrow money to fund construction, build apartments, and watch GDP grow. And repeat. But when housing demand slowed down, this entire 20-year engine just broke. Home prices weakened, major developers started defaulting, and land sales completely collapsed. And because local governments relied so heavily on selling that land to survive, they are now completely starved for cash.
You know, the debt itself isn't even the primary disease. Property is the real cancer here. This relentless cycle of building and borrowing created whole ghost cities and just massive excesses in steel and cement. And why does this matter to the average person living there? Because in China, property isn't just a place you live, it's literally the nation's largest savings account. When housing values drop, families instantly feel poor, and domestic consumption just hits a brick wall.
And compounding this whole property crisis is a silent killer: demographics. The old economic model relied on one core assumption, that there would always be more people tomorrow than today. Well, that assumption is officially broken. The population is shrinking, and marriage and birth rates are at historic lows. Simply put, fewer people means less demand for housing, less consumption, and a shrinking workforce. And let me tell you, a shrinking workforce makes a mountain of debt infinitely harder to repay.
So, this leads us to a pivotal question. It's one you hear Western analysts asking constantly. Can China simply turn on the printers and print its way out of this crisis?
While there are strict limits to what monetary policy can actually do. Yes, absolutely. Beijing can print yuan to bail out banks, prop up developers, and refinance local debts. But look at what money cannot buy. It can't buy young workers, new babies, organic housing demand, or real innovation. Printing money only solves liquidity problems. It is completely powerless to fix these deeply structural demographic realities.
Moving into Section 3, the prognosis.
What most people miss is that the biggest danger to China isn't some sudden fiery collapse. The biggest danger is Japanification. This draws a direct parallel to Japan's famous lost decades. We're talking about a scenario defined by low growth, high debt, a rapidly aging population, a weak property market, and deflationary pressure that drags on for 10 or even 20 years. Basically, China risks becoming Japan on steroids.
Now, what's really interesting about this slide is exactly why China hasn't suffered a 2008 Lehman moment yet. Unlike Japan's historic market-driven stagnation, a lot of Western analysts completely underestimate one massive factor. The Chinese state controls almost everything. Beijing controls the major banks, the capital flows, the currency, the land, and the state-owned enterprises. When you compare Japanese historical outcomes with current Chinese state control strategies, the difference is night and day. Unlike a free market economy, the Communist Party can simply force banks to cooperate. They can delay defaults. They can restrict capital flight. They can indefinitely postpone the financial pain.
So when we actually look at the probabilities, a sudden 2008-style financial collapse is very unlikely. We're putting that at only a 10% probability. There's a 30% chance of that decade-long Japanification we talked about, but the most likely scenario, at 60%, is a soft landing. But keep in mind, soft is a relative term here. We are talking about a managed decline from their historical 5 to 8% growth down to just 2 to 4% growth, propped up by constant, periodic stimulus.
And this economic reality forces us to do a geopolitical autopsy too, because we have to ask, does a weaker China become more aggressive or more cautious? In scenario A, Beijing focuses purely internally to manage this slow growth, which leads to less external adventurism. But in scenario B, nationalism becomes a necessary distraction for the domestic audience, leading to increased pressure around Taiwan, the South China Sea, and border disputes. This internal economic pressure undeniably influences their future border strategy and creates a lot of regional unpredictability.
All right, Section 4, the impact on India. Let's look at the risks and the opportunities.
The opportunities for India right now are immense, and they are immediate. As global companies execute these China plus one corporate risk management strategies, basically transitioning their operations away from stagnant Chinese markets, India is just perfectly positioned. There's a huge opportunity here to absorb supply chain relocations and really drive a manufacturing shift. Specific Indian industries, especially in things like electronics and chemical exports, are primed to gain immediate market share and replace that Chinese output. On top of that, India stands to attract a massive wave of global infrastructure investment that is currently fleeing the Chinese property market.
But we have to be real here. There are severe risks, too. Because China's domestic consumption is practically dead, they're going to export their excess goods at aggressively slashed prices. This means cheap Chinese exports, we're talking steel, solar panels, chemicals, machinery, are going to flood global markets. Plus, a slowing China means a massive slowdown in commodity demand, which ultimately means lower global growth. For Indian manufacturers, this severe price pressure and the risk of dumped exports is honestly a much more immediate threat than any military competition.
So, to survive and thrive in this environment, India needs a rapid action plan. The government must prioritize specific regulatory changes and essential policy reforms to attract that foreign manufacturing investment. They've got to fast-track initiatives to improve logistics and energy sector competitiveness. Crucially, India needs to massively accelerate semiconductor manufacturing to counter Chinese export dominance in electronics and execute critical infrastructure upgrades to support all this new domestic production capacity. India has to act now before China's slowdown turns into a desperate tsunami of competitive exports.
So the crucial point is perfectly summarized right here. The biggest opportunity is not China's failure. It is India's ability to capture the space created by China's slowdown. This isn't about sitting back and waiting for a collapse that honestly isn't coming. It's about recognizing that high cholesterol in their system and sprinting ahead while they're forced to walk.
This shifting landscape is literally a once-in-a-generation opening. But it leaves us with one incredibly pressing question to think about. Will India build its domestic capacity fast enough to ride this historic wave, or will its industries be swept away by a flood of dumped Chinese exports? The decisions made right now will define the economic superpower of tomorrow. Thanks so much for joining me for this explainer. Keep asking those big questions, and I'll see you next time.